Julia, I've been waiting to ask you about Caltex, confirming that the Kurnell refinery will close. What will be the likely market reaction, do you think?
I think this has already been built into the share price. We know that Kurnell was uneconomical and we were always expecting to see a closure in the second half of 2014. So we have seen this being confirmed today, and of course there will be costs involved, but this is likely to be offset by some of the benefits which will occur because of the transition to an export terminal. And I guess we will see some of the working cap being released. There will be also reduced maintenance capital expenditure going forward, as well as some tax benefits there as well. But if we have a look at Caltex's two main businesses of refining and marketing, it has been the marketing business which has been a lot more attractive. What we have seen on the refining side is that very high Australian dollar and also increased capacity from Asia, making this business quite difficult. In fact, if we have a look at the investment that Caltex has made in the 5 years up to 2011 in the refining business, it was an investment of about $1.3 billion, but that's resulted in an EBIT loss of about $360 million in that time. And then you compare it to marketing, where there's been a smaller investment there of just under $600 million. And if we have a look at the EBIT that's occurred from this business over the 5 years, it's been a much more attractive $2.7 billion. So we will see a closure of Kurnell. It shouldn't come as a surprise to the market. We will still see the Queensland refinery operating, and that's because of a little bit of a different product mix from the Kurnell refinery, where there is more of an emphasis on diesel, and that demand has been driven by some of those mining projects in Queensland. So I don't think this announcement is going to come as a shock to the market. I don't think we'll see much of a reaction in the share price, and it's already been built in.
And Julia, just looking at the market in general, obviously the SPI suggesting that we're not going to open too high, I guess, at this stage, driven by those stimulus hopes out of Spain. But is there anything else you're watching today?
It was an extraordinary session yesterday, and I think because we had such a strong session yesterday, we're probably going to pay a bit of payback today, and that's despite the very strong lead coming through from the US, where the US market was up by 1%. As you mentioned, it is all about China and Spain at the moment. That 2013 budget has been seen as a positive by the market and really paving the way for Spain to tap a bailout by the EU and of course the bond buying by the European Central Bank. We're watching China for potential stimulus. Yesterday we heard that a record amount had been injected into the system ahead of the week-long holiday, so that was all about liquidity. And China is closed for the Golden Week holiday all next week, so we're expecting it to be pretty quiet next week around the region. In terms of the US market, while we saw a rise of 1%, some of the economic data coming out was quite concerning. We saw durable goods orders in the month of August down by a massive 13%, and this is an important indicator because it really does reflect the confidence that US businesses have in investing in longer term equipment, and this shows some weakness in that business environment. And of course, we saw the second quarter GDP numbers, the third estimate, being revised down from 1.7% down to 1.2%. We have a look at how Australian companies might perform today. If we have a look at some of the American depository receipts traded in New York, we saw BHP doing well, up by 2.2%. We also saw Telstra doing well, up by 1.9%. And I think we are going to see more of an emphasis on these high-yielding stocks. Telstra has a yield of 7.2%, and that's not including the franking credits. And the reason why these stocks are going to be in focus is because of the interest rate decision on Tuesday. Monday's a public holiday for New South Wales. Tuesday's the interest rate decision. I think the market's a little bit divided on whether we are going to see an interest rate cut in October or in November after the CPI numbers are released, but most economists do agree that we are going to see a rate cut before year end, and that's going to put some of those high yielding stocks back in focus.
And Julia, of course, the countdown is on to the end of the quarter. Where have the winners and losers been?
It's been actually quite a good 3 months for the Australian share market, up by 7.1% and outperforming some of the other markets around the region. In fact, China's been one of the worst with a downturn, but the Korean Kospi also doing well, up by 6.8%. It has been the commodity-based stocks which have really done quite well on our market. If we have a look at the top three performers in the ASX 200, there have been stocks like OceanaGold, which is up by 63%, Drill Search up by 49%, and Bedell Resources up up by about 48% there. But the big material stocks, the big miners, they've really underperformed this quarter. We've seen BHP up by 5%, but Rio Tinto's actually been down by 5%. And of course, Fortescue has been slaughtered, down by 28%. And that volatility and weakness in iron ore prices has been a real feature of the quarter trading session. And I guess that's put a lot of pressure on some of those mining services companies as well. And we've seen quite a big downturn in the likes of Boa Longyear, which is down around about 40% for the quarter. But all up, if we have a look at it in terms of sectors, there's still been a tilt towards looking for safety, and it's really safety that's outperformed. Information technology, which tends to be high yielding, up by 17%, healthcare up by 13%, and we've also seen the staple sector up by 11%. The worst performing area has continued to be a continual underperformer, and that's been the consumer discretionary sector, which has ended the quarter quite